Welcome. You're listening to Mortgage Investing 101, the show where we discuss high yield real estate mortgage backed investment opportunities. I'm Edward Brown, your host, and I'm proud to introduce my co host, Mark Hanf, president of Pacific Private Money, one of the fastest growing private mortgage investment firms in Northern California. On our show today, our goal is to provide information and to increase your awareness of these important alternative investment strategies where you can earn, get this, secured high yields using your savings or IRA accounts. And annual yields of 8% and more are not uncommon using these strategies we're going to discuss on today's show. So make sure you pay attention. And if you like what you hear today, you can call Pacific Private Money at 415-883-2150 or for more information, or go to pacificprivatemoney.com. For fun, we're also going to have trivia contests before each commercial break, where the first three callers with the correct answer will win a free 3-day, 2-night vacation. Now, the vacations are not sponsored by the radio station, but by Lighthouse Resort and Marina, located 1 hour northeast of San Francisco. The vacations are free. Lighthouse is only requesting a $75 house cleaning fee. Check them out at lighthouseforfun.com. Today's trivia theme is various types of doctors. Okay.
TV doctors or just regular doctors?
Just regular doctors. We're going to see how intelligent the audience is. And how
And me
intelligent.
too.
And you too. Yes, exactly. Okay, so Mark, the name of the show is Mortgage Investing 101. And why don't you give us a quick little brief snippet as to what exactly investing in mortgages means?
So, Mortgage Investing 101 is a show to describe in detail the products that we sell at Pacific Private Money and have been selling since 2008. We've originated over 600 loans, real estate loans, secured by Bay Area real estate since 2008, and every one of those loans have been funded by private individuals who are participating in the alternative investment strategy known as mortgage investing. Now, it goes by a couple of different names, and we've talked about that on other shows. Sometimes it's called trust deed investing because mortgages in California are actually secured by a recorded deed of trust or a trust deed. So trust deed investing is a common name for it. It's also called private lending. It's also called, it's also when you invest in a mortgage pool fund, which are growing in popularity once again. Mortgage pool funds, which we'll be talking about a lot on this show today. The Pacific Private Money Fund is currently paying a little more than 8.5%. In fact, next week we'll be announcing the fourth quarter yields for the fund. But mortgage pool funds are another way to participate in the alternative investment strategy of increasing the yields in your investment portfolio, earning high yields where 8% or more are not uncommon, and these are secured returns. That's what really sets mortgage investing apart from just about any other type of investing. We're talking about secured returns, secured by assets which have equity.
Okay, so we'll go to that in just a minute, but I want to ask you a question because you mentioned in the beginning of the show that you've been doing this since 2008, and the first thing I'm thinking of is, oh yeah, well great, what happened during 2009, 10, and 11 when real estate just got hammered? How much money did people lose in investing with you?
Well, no one's ever lost money investing in any product generated by Pacific Private
Even
Money since
during
2008.
Even during the downturn?
No, and the reasons why, and again, we'll get a little bit into this, but see, real estate, whether it goes up or whether it goes down, it doesn't happen quickly.
Okay.
And the types of loans that we fund at Pacific Private Money, and it's the type of loans that most private loan originators, also known as hard money loan originators, most of the types of loan products we generate are short-term in nature. Our borrower clients are real estate professionals and real estate investors who need capital for a short-term period to help them buy, remodel, and then resell, also called buy, fix, and flip. They're basically property flippers, but they're different flippers than those who were flipping properties in the early 2000s when we were in that real estate bubble. Most people who were flipping property back then didn't do anything to it. They just bought it.
Yeah.
It went up, it was going up, how many, 2, 3, 4% per month. And then they'd hold it for 6 months and flip it. Woohoo! They made a bunch of money. Well, we don't work. That market's gone. It's in, and I hope it doesn't come back again because that was not a healthy market. No, the loans we're making are to flippers who are actually adding real value to real estate. Their goal is to buy a home that needs remodeling, getting it hopefully at a price that's competitive competitive or below market, and there's ways to do that. Adding value by doing a remodel, kitchen, bath, paint, carpet, sometimes even more than that. But that's a very common remodel, and then putting it back on the market and making a maybe $25,000 to $50,000 quick flip profit in the San Francisco Bay Area. And those people, generally speaking, like to use short-term loans, and that's what we provide them.
Well, I think part of the importance here is the fact that you are not making loans that are high loan to value, so that even when the market went down 25%, your loans were still well secured.
Well, that's the other part of the equation. So when I said, when I was introducing what mortgage investing was all about, that it's secured by assets with equity, what I mean by that is the average loan to value, for example, in the Pacific Private Money Fund is currently, and I just checked this today, it's 61%. So that means that the total value of the assets that are secured by the loans that we made against those properties is 61% of the fair market value of the property, or the purchase price of that property.
Okay, so $1 million, to make the numbers simple, on $1 million property, and that if the average stayed the same, you would only be into it for $610,000.
That's exactly right. So
Okay.
there's protective equity, as we call it in the business, which means that if there was a problem with one of the loans in the portfolio and they stopped making payments, we would be able to begin the foreclosure proceedings, and within a 4 to 6 month period of time, which is the average foreclosure time period for when you're foreclosing on investment property. Because keep in mind, we're not making consumer home loans where someone could string this out for 3 years. We're making loans on investment property, and when you make a loan on investment property and you foreclose on that, let's just say if they wanted to file bankruptcy and try to stave off foreclosure, that doesn't fly on investment property. We're able to get that removed from bankruptcy very, very quickly. And again, I'm talking because I know this not from experience, because we've actually never experienced that, but I know of others in the industry who've been able to foreclose successfully on these properties within the 4 to 6 month time period. And if we had to do that, it would actually be good for the fund, because the fund would be able to turn around and either sell that property at a profit, or the loan itself would be repaid by maybe an investor at the courthouse steps. So I know we're getting off on a little bit of a tangent there,
Okay.
but the thing to keep in mind is that we're talking about secured returns, where our target payout, for example, on our mortgage pool fund is between 8 and 9% per annum, and we're able to achieve those yields consistently and securely by making loans to real estate investors at an average rate of about 10%. The note rate is about 10% per. Sometimes it's a little bit higher, sometimes it's a little bit lower, but it's within that range of 9 to 11. It's probably 90% of the loans we write.
And this has nothing to do with the stock market.
No, it has nothing to do with the stock market. It has to, and it really. We're going to get a little bit more into this in the show, because what I want to talk a little bit about today is okay, we're offering 8% or more yields in a method that we believe has safety and security features not found in other investments. We're using it. The vehicle we use are real estate secured loans. What does that mean then in terms of what the real estate market may or may not do in 2014? And so the point I'm going to make, and we'll talk a little bit more about this in detail as the show goes along, is that it really doesn't matter, because if real estate trends down in 2014, my borrowers aren't going to get hurt that badly. They may not make as much money as they hoped to, or maybe they break even, maybe they lose a little bit, but our security is protected because we're not exposed to the market fluctuations that are going to occur over a 6 month to 12 month period.
Well, yeah, as an example on that one that we used where it's $1 million piece of property, and your fund has lent $610,000. Even if the market drops 15%, which is huge, that property would still be worth $850,000, and your loan is only $610,000.
And there's no way it's going to drop 15% in 2014, because not even in 2007 did the market drop 15%. I mean, it dropped between 30 and 50% over a 4 and 5 year time period, which began sometime in between 2007
But
and
you don't get hurt
2008.
because your loans are short term.
That's exactly it. That's the whole point. Is that
They're like bridge loans.
we fill a market demand. We, meaning Pacific Private Money, is a real estate loan originator licensed to do business in the state of California since 2008, and we have specialized and focused on loans to real estate investors, short-term loans, 6 to 12-month loans on average, to those who are buying, fixing, and flipping. And so the other part of the protective equity, which is noteworthy, is we generally don't make a loan, for example, that's higher than 70% of the acquisition price. Now, our borrowers are buying homes at anywhere from $250,000 to $1 million in the Bay Area, with the idea that, number one, they're getting a good value on that acquisition. Some of them are buying them via short sale and they're getting a good discount. But their intent is to put additional money in there to remodel it and increase the value. So on a typical loan that we make to a rehabber or contractor or real estate investor that starts out at 70% of the acquisition price, by the time they've done putting in their own money or their investment partner's money in improving the property, more often than not, our loan-to-value exposure is less than 50% loan to
keeps going
value.
down every
It
time
keeps
they-
going
yeah.
down. That's just it.
Okay, so just as a reminder, you're listening to Mortgage Investing 101 with Edward Brown, that's me, and Mark Hunt, president of Pacific Private Money. If you like what you hear so far and you have questions, you can call Mark directly at Pacific Private Money at 415-883-2150. Just leave your name and your question and your phone number, and he'll get back to you after the show, even if it's on a Saturday. Okay, we're going to cut to our first commercial break. Here's our first trivia question. Again, the theme is various types of doctors. What kind of doctor deals with diagnosis and treatment of heart disease? What do they call that kind of doctor? The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-529-1134. That's 888-529-1134 to answer this question. What kind of doctor deals with diagnosis and treatment of heart disease? One more time, 888-529-1134. Make sure to include your name and your email address. Speak slowly. Spell out your email one letter at a time. Don't touch that dial. Mortgage Investing 101 will be right back. Hey, is this what they call a 1003?
That's right. 1003.
Ready.
Yep.
We're going to get into why it's considered the best kept secret.
Yeah. It's just good to consider some of the features of mortgage investing. Just rattle off a few of the things that are always noteworthy.
Okay. Welcome back to Mortgage Investing 101. I'm Edward Brown, your host, along with Mark Hunt, president of Pacific Private Money, the fastest growing private mortgage investment firm in Northern California. When we cut to the first commercial break, we asked this trivia question. And again, the theme is various types of doctors. What kind of doctor deals with the diagnosis and treatment of heart disease?
Oh, Edward, you're such a card.
Yeah.
Are you a cardiologist?
A cardiologist, that is correct. That's funny, I like that. Okay, so now, Mark, I know you want to talk about some aspects of this, and then I want you to get into why it's the best kept secret, not anymore, but why it was the best kept secret around.
Well, there are a number of features that are worth considering when we talk about the alternative investment strategy known as mortgage investing or private lending or mortgage pool investing, or trust deed investing, a number of names, but all of which are essentially when you are investing your money in either a pool of notes or an individual note secured by real estate. So, number one, it's one of the few ways that exist in today's market to earn high yields of 8% or more consistently on an annual basis. I mean,
But it sounds like you're really like the bank investing in mortgages, just like if I were to go buy a rental property and get a bank loan, except that your interest rate's higher.
well, you are, and one might be asking, well, why wouldn't they just go to the bank and borrow at 4 or 5% instead of go to you and borrow at 10%?
That's my next question.
And that's one of the questions we will get into because there's actually some very good reasons. But I want to stick with just real quick to talk about some of the features of mortgage investing. We just mentioned high yields. The other one is it's a no-fee, no-load investment strategy when done correctly and when you work with a reputable, licensed originator of privately funded loans. So our investors don't incur any fees whatsoever when they invest in our products, and they don't pay any fee going in. They don't pay any fee going out.
Is that why my stockbroker hasn't told me about it?
Well, that's one of the reasons why. In fact, that's one of the features. That's one of the next features. Is this is not a strategy you're going to hear about from your stockbroker or financial planner. And one of the primary reasons that is because, well, number one, they can't earn from it. It's not something that is commissionable to a stockbroker. Although if you have a financial planner who's fee-based, and then and it truly cares about your financial well-being, they really ought to be at least exposing you to the option, the alternative investment strategy of mortgage investing, because again, more and more people are becoming very interested and involved in this investment strategy. Another feature is that it's incredibly easy. I mean, not that buying stocks or bonds or mutual funds is hard. It's not. But one might think, well, that's got to be a fairly
sophisticated, complicated.
Yeah, complicated. Yeah. It's really not. It's so incredibly easy, and we make it easy for our clients. In fact, the easiest of all is investing in a mortgage pool fund. You literally write a check to the fund because we at Pacific Private Money then we make the investment decisions on the fund shareholders' behalf. If you're investing in individual notes, you are going to be looking at the property profile information. Maybe you're reading preliminary title reports, studying the credit report of the borrower. Again, some of my experienced individual note investors, they love doing that. That's that to them it's fun. Now, I will say that individual notes are getting harder and harder to invest in, which is why mortgage pool funds are becoming more popular, particularly with brokers such as myself, because I actually have too many investors on the individual note side right now, too many people who've been doing it, and more people have been getting into the act. I actually, quite frankly, think that a mortgage pool fund is a better avenue for people who are not real estate sophisticated, because again, I've been in real estate for 32 years. It's all I've ever done, and so that's one of the reasons why my clients like.
Well, I'll give you another reason, because I've invested with your fund, and so sure enough, I've been earning over 8.5%, and when I got into your fund, I started earning the interest virtually right away.
Mm-hmm.
I got an email from another hard money lender, and this was a smoking deal that they were offering.
Yeah.
And so I had answered the email, and I said, yes, I'm interested. And about 2 hours later, the guy gets back to me and says, well, I'm sorry. I know I sent this out to you, but I sent it out to a whole bunch of other people, and someone was faster than you. So here I get all excited, thinking I'm going to get this great deal, only to find out that I don't get it. So now my money's sitting in my bank account at 0% interest, waiting for another deal.
Well, that's one of the nuances of today's market when you're trying to invest in individual notes. The very, very competitive and the highest quality notes go to those investors, those private lenders who can react very quickly. They've literally got their phone on them all the time. They're checking their emails regularly because they're playing this game of trust deed investing, and they're able to make up their minds very quickly. They can review an opportunity and commit to that very quickly, and that's what a lot of brokers rely on in this market, because oftentimes our borrowers call us with 5 days to close saying, well, I had a bank commitment, but they backed out, and now I got to close with private money, so can you close by Friday? And so,
that's probably one of the reasons why you get the loan versus Bank of America, because they can't act that fast.
well, that is one of the reasons, and we will get into, again, before the show's over, we'll talk a little bit more about why would anybody go and pay 10% for a private money loan when bank loans are 4 and 5%.
Remind our audience what the name of the show is.
We are Mortgage Investing 101. I'm Mark Hanf, broker and president of Pacific Private Money. We're based in Marin County, have an office in downtown Novato. Our phone number is 415-883-2150. Again, 415-883-2150. And for a little more information about the Pacific Private Money Fund, as we call it, you can go to our fund's website. We have a specific website that we just launched, built specifically to give information about our mortgage pool fund. It's pacificmoneyfund.com. Of course, all one word, pacificmoneyfund.com. So we were talking about the features of mortgage investing, and you gave a little hint earlier about how it's been referred to as one of the best kept secrets in financial planning, and it really is no longer. And again, that's one of the reasons why individual notes are more difficult for the individual investor to get in on. However, what is great about a mortgage pool fund and what's great about the Pacific Private Money Fund is that we at Pacific Private Money, we market like crazy. We do this radio show, we do the Best of Investing radio show on our sister station at 1 p.m. on KNEW.
Or KKSF 910.
We are on KNEW. That's right. This is KKSF. Sorry about that. I'm a little confused. And well, we do a lot of marketing and promotion. I'm going off to a real estate event tonight to promote Pacific Private Money, and we get great deal flow. So our phone rings constantly from real estate investors and brokers representing real estate investors looking for a private money loan, and we have great repeat borrowers as well. So we have good quality deal flow, and we cherry pick those loans and put the best loans in the fund. So our individual investors don't even get to see the best loans. Our individual investors do get to see some individual loans when we have a little bit of overflow, but by and large, our mortgage pool fund is getting first crack at every deal that comes through, and particularly the low LTV ones that my individual investors would just salivate for.
Sure.
But again, that's so my promise to our shareholders in the fund is you're going to get the best of the best.
Well, what's interesting is you mentioned about how much marketing you do, and I just coincidentally happened to run into somebody who was an attorney who was trying to get my opinion about a specific deal that was his client was looking into. And guess who had the first loan on it? Pacific Private Money.
Fancy that.
Yeah, and I looked. I said, "Boy, what a smoking deal Pacific Private Money got in this thing."
Right.
First loan at 40% loan to value. I mean, it's great. So, why don't you? Can you get into the risks a little bit more? I mean, it's one thing to kind of just go, "Well, you're the lender, so there's not much risk." But I mean, realistically, again, I'm kind of listening to this, trying to be an outsider, and going, "Why would anyone pay if it's that riskless or less risky? Why are these borrowers willing to pay such a high interest rate?"
So if you're listening to this show, live on radio or maybe via podcast, and you have an idea in your mind of, oh yeah, I've heard of those guys, those hard money lenders. They make seconds and other types of predatory high rate loans to people who are in dire financial stress. And I'm going to tell you that that's not the business model that most private lenders today and for the last 6 years have followed. And we at Pacific Private Money have never followed that business model. That is an old business model. That it still exists because there's still people who are desperate for money, and they'll find these people who will make them, for all intents and purposes, a predatory loan. But we don't make loans to consumers. We don't make seconds, generally speaking. We do from time to time when the deal makes sense. And sometimes people have a ridiculous amount of equity in an office building or a rental property, and we'll make them a second. But We're not making seconds to homeowners who, you know, think that, oh, if I just got a loan for 50,000 or 100,000, everything would be better. And really, all you're doing is they're digging themselves a hole, and you're selling them a shovel. Yeah, right.
Yeah, exactly.
A golden shovel at that. So, so we don't do that. So we're not like the old, you know, hard money lenders of 20 years ago or even 10 years ago. That industry, while it still exists, that is not what private lending is today. Today's private lending industry really sprouted in 2008 as a result of what happened in 2008. And what happened was we had the real estate bubble pop. The financial meltdown occurred in the fourth quarter of 2008. We had TARP, we had all that stuff go on. The banks, you know, and we know why it happened, because the banks were making 100% loans and more to people who couldn't afford or really relying on their loan applications about their ability to repay. So banks pulled back on their lending criteria. Congress passed a whole slew of laws to prevent that type of thing that was going on in 2005 from ever happening again. And so there was a void in the capital market for the real estate investors seeking leverage to buy investment property. And the private money loan organizations like Pacific Private Money were created to fill that void. The market, you know, it always responds when there's a vacuum, right?
Yeah.
I mean, so lack of capital for real estate investors has been filled by the private money lending industry, like Pacific Private Money. So our 600 loans, virtually, 98% of those loans are to real estate investors, and of those, most of them were for the purposes of buying, fixing, and flipping.
And it seems like speed seems to be your greatest asset.
It is our greatest asset. Banks cannot, even if you have a great, let's say you're a borrower, you've got an 800 FICO score, you have, $500,000 cash in the bank, you've got a 401k worth several million, and you own other real estate.
And you have a current appraisal in your hand.
Right.
It still doesn't work.
Right. If you need to close in 10 days, the bank is just not set up to accommodate
because
that.
they're not, a FIREA says they're not allowed to accept those appraisals. They have to order their own.
Right. That's
Start
exactly
all over again. Okay, you're listening to Mortgage Investing 101. I'm Edward Brown, your host, along with Mark Hahn, president of Pacific Private Money. I'm sure you like what you hear today. Give Mark a call at 415-883-2150 for more information about investing, earning over 8% secured by real estate. Here is the second commercial break trivia question. Again, the theme is various types of doctors. What kind of doctor specializes in treatment of cancer? The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-529-1134. That's 888-529-1134 to answer this question. What kind of doctor specializes in treatment of cancer? One more time, 888-529-1134. Make sure to include your name and your email address. Speak slowly and spell out your email one letter at a time. Don't touch that dial. Mortgage Investing 101. We'll be right back. Specializes in tushies.
That's right. Do you have that as the third question?
No.
Right.
No, remember, there's only two questions in this one.
Oh, that's right.
Yeah.
So ask me again to go back and say, I know you touched on it, but let's talk about why would anyone be willing to pay 10%? Why would a borrower pay 10%?
Okay, let's do the deal of the week, and you can give an how about that?
Okay. So what do I want to do for deal of the week? Oh, gosh.
I'm glad this thing is working out so well that people can get the money working right away.
Probably gonna have more next week. Good. In fact, I will, because yeah, that's right. It won't be 100, but was holding some back to see what the distributions would be,
Yeah.
which I'm supposed to get tomorrow, and then I think I have another 75,000 left from Johnson Trino's investment today. That's clearing. It should clear by tomorrow. And but I wanted to, I had, you know, I didn't want to have that rest of that money sit any longer. I actually probably could have brought you a check on Monday, but a few days isn't gonna. Just doing the math, it's like 2%.
Yes. Okay, here we go. Welcome back to Mortgage Investing 101. I'm Edward Brown, your host, along with Mark Hunt, president of Pacific Private Money, the fastest growing private mortgage investment firm in Northern California. Mark can be reached at 88415-883-2150 for more information about investing in hard money real estate loans through his fund. And when we cut to the second commercial break, again, the theme is various types of doctors. We ask this question: what kind of doctor specializes in treatment of cancer? And don't say proctologist. What's the
Is it
answer?
oncologist?
Oncologist.
Yes.
Very good. Boy, you are a doctor yourself. We're going to call you Dr. Hunt.
And we don't cheat. He doesn't give me the answers
No, I
between
know.
commercial
No.
breaks.
And Mark does not look at it on the internet either. Okay, so Mark, you know, we forgot to mention when we cut to break that we like to talk about deal of the week.
Yes.
And this will also help explain why these borrowers are coming to you instead of a bank. Give us an example of one of the latest deals you've been working on.
Well, it almost seems like every deal we get has a time component that is really short term. And much of the time it's because they did go to the banks first. And the bankers said, oh yeah, we can do that. You know, we can close in 3 weeks, or we can close in, 30 days if they in fact had 30 days. And in fact, one of the loan applications we got this week, I'm looking at the signed contract, and it's dated early December. So they did in fact go and work with the bank. Now, this particular one was actually a former client or a repeat client, I guess. Hopefully we'll get the deal done for him. If he doesn't, if his bank doesn't pull through last minute, then he's buying an apartment building in Sacramento. This particular guy specializes in buying apartments. The loans we've done for this gentleman in the past were for apartment building acquisitions in the Sacramento Valley. And so he's got his hooks on one that looks really nice. The details are not important. It's multi-units, about 20 unit, and for roughly, just under $2 million, and good price per door, and everything seems to make sense. And again, I know this guy personally. He's got great credit and good liquidity, and he's got experience. He's been doing apartment investing for 20 years. And
So
actually,
what does he need you, Mark Hunt, for?
well, his bank just seems to be giving him the runaround. And I can't tell you how often I hear this in one form or another. They just keep asking for more information.
Maybe
so he gives them what they want.
Maybe he's got too many loans with him.
Well,
Sometimes that happens.
oftentimes it happens, but again, it's getting bogged down, and the seller is starting to make waves. Sellers saying, "Look, I've got backup offers, and if you don't close, I'm not willing to give you an extension beyond the contract date." And that contract date is for January 21st.
And the seller may be thinking the buyer's giving him the runaround.
Well, that too, because oftentimes, we as buyers will blame our bank when things aren't going as swimmingly. Maybe we didn't tell the seller that we didn't really have the cash down payment because we're running around trying to find an equity partner. Which,
exactly.
again, as a lender, I can't tell you how many times I know that's what's happening when I get a phone call from a borrower when they balk and I say, "Well, I need to see proof of funds."
Sure.
And they say, "Oh, let me work on that for you."
Yeah. Okay, so a lot of times I know that the banks will also drive you crazy with, please provide purchase of where this $300 deposit came from out of $15 million worth of deposits. So this specific example, the purchase price is how much?
It's just under $2 million.
$2 million. Okay, and how much money is your borrower coming down with?
Well, he's looking for a 70% acquisition loan. Again, he knows how private money works. He knows that he may be able to go to a bank for 80%, but he's not going to find a private lender at 80%.
So he's going to put down 30%, which is $600,000.
Yes.
So he's got real skin in the game. The odds of him walking away from that loan are pretty small. It could happen, but it's pretty small.
Absolutely.
Okay.
Another example this week, again, another repeat borrower calls us up and says, "Hey, I'm looking to buy a home in Pleasanton, and I'm not going to rent it out. I want to keep it as a second home because my home is in Fairfield, and my job that he commutes to is in Pleasanton." And so he's been, keeping his eye out and found a short sale opportunity and made a very aggressive offer with a quick close. Now he knows he can't get a bank loan for a quick close, so he contacted me and said, "Hey Mark, I found this opportunity. Check it out. Look at the address. It's not a market sale," because he knew that I guess there was a notice of default filed against this homeowner. He approached that homeowner. They negotiated a price. It looks like it's below market, but the clock is ticking on the foreclosure, and he has made a very aggressive offer. And again, this is something the bank is not going to be able to
It's funny because even if speed wasn't the case in this instance, it also could be sometimes people just don't qualify for two homes. That happens a lot.
It does. It does. In fact, I'm guessing that's probably this gentleman's case as well. Although once he owns the property, being able to qualify for bank financing to take out and pay down that what will be a more expensive, of course, private money first. Will be easier to do. And there's not a time constraint. Now he's got the time to shop that around to maybe a regional bank who will look at his income and credit and go, that looks like a pretty good loan, and it might take them 30 days to fund it.
One thing I want you to talk about is the fact. See, I know these answers, so I can softball question these up to you. Is if that deal, let's say, is in the fund, if the guy pays it off sooner rather than later, it doesn't sound like it's going to be that big a deal to you because you share the points with the fund, and there may even be a minimum guarantee of interest. So explain those two items that I just confused the audience with.
Right. So what Edward's talking about is in the Pacific Private Money Fund, the way we design the fund for the income stream to our shareholders, it's a little bit different than most mortgage pool funds. Most mortgage pool funds, the income to the fund is 100% from the note rate. So if the fund is populated with real estate secured loans earning an average of 10%, then they are going to get their returns from that 10% after the management fees and administrative fees have been paid out. Now, at the Pacific Private Money Fund, we of course also have a fund manager monthly fee, and we've got administrative fees. Again, these are typical, but what we do that's not typical is that the origination points that we charge, that pretty much every hard money and private money loan broker charges, we split that 50-50 with the mortgage pool fund, with the fund shareholders. So when we make a loan for $500,000 and we charge 3 points, that $15,000 is split, and $7,500 of that fee goes into the fund, and the other $7,500 helps pay my sales staff at Pacific Private Money for brokerage. So why that's important is because we designed the Pacific Private Money Fund to profit from short-term loans. So we don't care if someone pays us back in 2 or 3 months and that money is back in the checking account in cash, because we've put the points into the fund.
The more you can turn the money,
right, it increases the yield.
Yeah.
So it also allows us to be a little bit more aggressive with the note rate. And so maybe the note rate, maybe we might normally quote 10%, but this guy is shopping and we really want this loan because it's a great borrower, great location, be perfect for the fund. So we offer him a 9% note rate. And so we're not, it doesn't negatively impact the fund shareholder because again, it's more than likely a short-term loan and half the points are going in. So that all serves to allow us to be aggressive and price our note rates to get the deal. And in the San Francisco Bay Area, it is fairly competitive in the private money lending realm. You might not know that. You might think, oh my gosh, 10%, that sounds crazy. Well, 5 years ago, 12% was the average note rate. So it's actually gone down. And so as have points, a hard money loan in 2008, if you were quoted in the San Francisco Bay Area, 12% in 5 points.
That's norm.
That was fairly normal.
Yeah.
Well, that same loan today for the same property and the same borrower might be 10% and 2 points. So really, it's yet we're still able to achieve yields of 8% or more for our shareholders, which in an era where as far as the eye can see, we're not going to be making interest income in our money market account or from bonds or from CDs.
Well, let's talk about that. You just reminded me of this question. Explain the liquidity. Let's say I invest in your fund, and I'm going to earn, right now it looks like over 8%, fairly conservative because the very low loan to value on the properties. But I don't want to lock my money up in this thing for 20 years. How do I get out?
So we have a minimum redemption commitment period or investment period of 2 years. So we don't want people to treat this like a money market account, because at Pacific Private Money we have a business model. We're funding loans. We want to be able to rely on the capital that we have in the fund. And so we ask that our shareholders, our investors, commit to keeping their money in there for a minimum of 2 years. Well, stuff happens, right? What if you need to make a redemption request, is what they call it? What if you need to ask for your money sooner than that? Well, we can pay you off sooner, and we will pay you off sooner if you need to get your money out in a year. But the fund is designed to. We have a redemption fee for early withdrawal, so there's no. If you need your funds after 2 years, there's no redemption fee whatsoever. But within that first 2 year period, if you had to get your money out in the first 6 months, we're going to charge you a 5% redemption fee. It goes from 4 to 3 and then to each successive 6 months. So by the time, if you needed your money out, let's say in month 18, you'd be in the last 6 month period. It'd be a 2% redemption fee. So, but keep in mind that
you're earning over 8% during that
right.
time.
If you're earning 8%, let's just say non-cumulative, if you were in there for a year and a half and you earned 12% on that money, and there was a 2% fee to take it out early, I mean,
you're in 10% over a year and a half,
still money
7%.
So it is liquid, and I will again just to be complete and succinct on how the liquidity works. It's not like a money market account where if you need the money tomorrow, let's say it's 2 years have gone by, there's no redemption fee, you're outside the redemption fee period. If you needed your money tomorrow, I'm not going to be able to accommodate that. We do redemptions on the first of every month, because that's when our shares are priced. Our shares are priced monthly, not daily, as mutual funds are. And the reason why it's monthly is because we're looking to keep the administrative fees as small as possible. So we evaluate the share prices at the first of every month and adjust them. And then we make distributions quarterly. We don't make monthly distributions. We make quarterly distributions.
But when you adjust the price, I mean, I'm still thinking though that my principal's intact, right? I mean, it's not the stock market. You say the share price adjusts.
Share prices are start out at $1,000 and they go up as interest and origination points are earned by the fund. And at the end of every quarter, we distribute the amount that's earned above $1,000 a share. So it gets the fund gets adjusted back to $1,000 a share at the first of every quarter.
What is the minimum investment?
$50,000 is the minimum investment, and you need to be an accredited investor. And the definition of an accredited investor is that you have a net worth of at least $1 million, and that can't include the equity in your primary residence. Unfortunately, the government has sought to bolster the definition of accredited investor. It used to be able to include the equity in your home, but now it does not. So you need to have a net worth exclusive of your primary residence of $1 million, or if you're single and you make $200,000 or more a year for the last 2 years, you're considered accredited. Or if you're married and you make more than $300,000 a year for the last 2 years, you are considered accredited. So there is a qualification. We're not looking for, as they say, orphans and widows to invest their last dollar in this. We're looking for sophisticated investors who are looking for ways to increase the average annual yield on their savings and retirement plans. And while I'm at it,
the retirement. Go into
retirement plans. If you have a self-directed IRA, one of the reasons why you would open up a self-directed IRA is to be able to invest in alternative asset classes like buying real estate or investing in individual trustee notes or investing in a mortgage pool fund like Pacific Private Money. And so a lot of our shareholders have opened up self-directed IRA accounts. They've rolled over some of their 401ks or IRAs from other institutions into a specific self-directed IRA. Now that could be still a traditional IRA or it could be a Roth IRA. Just because it's self-directed doesn't mean it's a Roth IRA. Some people confuse the self-directed and think it's automatically a Roth IRA, but you can have a self-directed 401k, you can have a self-directed traditional IRA, as well as a self-directed Roth IRA. The key is, though, you have to have it with a company that's truly self-directed as opposed to an account with a brokerage firm that calls it self-directed, but it's really not. It's just you get to choose between their mix of stocks and bonds and mutual funds, but you really can't invest in outside assets.
Okay, before we have to cut out here, how do people get a hold of you?
So there's many ways that you can find out more information about mortgage investing. One way is, and we haven't mentioned that yet, is our radio show has its own website where you can go and listen to this show in its entirety via podcast or previous shows, and that's mortgageinvesting101.com. Again, mortgageinvesting101.com. And the Pacific Private Money Fund has its own website at pacificmoneyfund.com. You can also get there by going to pacificprivatemoneyfund.com. Either way. Or just call us, 415-883-2150.
Thank you, Mark Hahn, for joining me again on Mortgage Investing 101. Tune in next week to Mortgage Investing 101. We're going to be giving away more free vacations for answering trivia questions and giving more valuable information about mortgage investing. Right now, Mark Hahn's fund is paying over 8%, actually more than 8.5%. Thanks for listening. I'm your host, Edward Brown, and on behalf of Mortgage Investing 101, so long. We'll catch you next week.